All right, hello and welcome to yet another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have Evan Tindell. Evan is the CIO of
Bireme.
Tell me. You told me before and I forgot it. Bireme Capital. Evan, how's it going?
I'm doing well. How are you?
Hey, I'm doing great. Thanks so much for coming on. We're excited to have you on. Let me start this podcast the way I do every podcast. First, a quick disclaimer. Nothing on here is an investing advice. Do you really want to take investing advice from a guy who can't even pronounce his guest's firm name? But just remember, nothing is investment advice. And then second, a pitch for you, my guest. I think you're easily one of Finchwit's top 100 former poker players turned professional investors. But, we've swapped notes and thoughts over the year. I find you to be a really thoughtful guy. You bring that poker player, hey, I'm looking for an edge. I'm looking to think rationally. I'm looking to think logically, think to markets. And I think that's going to shine through in this podcast. So excited for our discussion. That out the way, let's turn to the stock we're going to talk about. Sure. It's a little bit of a different stock than I think you've generally looked for, but there's all the makings of what you look for here. The stock is Tencent Music. The ticker is TME, and I'll just flip it over to you. Why are we so interested in TME?
Sure. Yeah. So this is actually the first time I've ever gone long a stock with the business in China. I actually we didn't actually talk about this before, but I spent a whole year pretty much spending most of my time figuring out which of the Chinese reverse mergers to short.
Which did you end up shorting?
Oh, so many. I don't even, so many.
When you look,
I can remember all the tickers.
Let me sidetrack this for a second and ask a question.
Sure.
Chinese reverse mergers, a lot of people made a lot of money on, and these were, I don't use that word lightly. A lot of these were just out and out frauds, right? But a lot of people made a lot of money on it. And I look back on that and I wonder if that happens in today's market, how many professional investors would have gotten, kind of carried out in a body bag? Because I think of the meme trading especially in January and February. And I think of these Chinese reverse merger stocks, as soon as the short interest went up, I feel like you would have seen retail traders just trying to send shorts in a body bag. And you even saw this with Tala Education and a couple of other things that got squeezed in 2020. All of them ended up being pretty much, I won't use that word there, but they were very shady. And people got carried out in body bags because people were just gamma squeezing into the moon. Have you thought about that?
Yeah, I mean, so Muddy Waters is the research firm focused mostly on shorting, or originally it was just Chinese stocks. Now they do a little more stuff in Europe, although it's still kind of Asia focused. They were putting out a lot of the research back in the day that kind of was showing, how fraudulent some of the companies were. And so we followed them, and they, a lot of their research is what got us interested in the space. And so, yeah, they were short GS. Perfect example is they're short of GSX. Like if you pull up a chart, I mean, it went from, I actually talked about this in some of our letters. Well, the ticker is GoTo now.
Yep.
But it went from like, I think they started calling it a fraud
at about
summer of 2020-ish.
Yep.
And it went from 30 to 130, And so, yeah, I mean, if you're the type of, we usually, my firm, we short things and we put on 2% positions, you end up having to cut your losses at some point, right? Because it gets too large, and you just can't be having, you can't be having 8% short positions in one stock. At least that's not how I operate.
No,
but yeah, you can get crushed. Yeah, for sure. So who knows? I mean, it's a perfect example of exactly the craziness that can go on in today's market. It didn't have things that didn't quite happen like that back in 2012.
Yep. Yeah. No, I agree with you. It's just something that I've been percolating as I think through shorts, because I very rarely short anymore. And this is one of the reasons, the go-to example you gave is perfect. I remember I bought some puts on it, and some of them paid off, some of them didn't. But I remember just being that this is an obvious fraud and it's tripled on me. I don't see why I'm even playing the fraud game at this point. But anyway, let's go back to TME.
Sure. Yeah. Right. So I always had a little bit of a distaste for anything related to China because of my experience with the Chinese reverse mergers. It's just I'm the type of guy that I'm sort of mostly a guy that focuses on statistically cheap stocks. I like to fish in ponds that I think have where the whole pond is likely to outperform, over time, with the primary example of that being statistically cheap stocks, although that strategy just buying statistically cheap stocks obviously has done terribly over the past 10 years, but that's kind of how I think. And so like being invested in Chinese stocks historically has kind of been the opposite of that. It's just fishing in a pond where there's landmines and fraud, and so I never touched it from the long side. But with the sell-off in all of these names in 2021, I started thinking, maybe it's time. Maybe it's time to take a deeper dive on some of these companies. And I started looking at some of the ones that were down the most and that were the most interesting to me in terms of the business models. And then, I was familiar with Tencent Music because we've owned Bolloré for a long time, and their largest asset these days is a stake in UMG, which they got spun off from Vivendi, which I know you're well aware of that story. But the reason why Universal Music is so, well, we can get into the reason why Tencent is so advantaged, but I was just aware of Tencent Music because of that relationship, and they actually own a piece of I think they own they net own like 2% of UMG, actually, Tencent Music.
I think that's right. And they own a little bit of Spotify. Spotify and Tencent Music did a little share swap, which for a while when Tencent Music was a rocket ship and Spotify was flat, Spotify would always be like, this is why we're not buying back our stock. Look at the investments we made in Tencent Music. And now Tencent Music's down and Spotify's up and they're buying back stock.
It's kind of funny you mention that, because we can talk when we talk about margins, or if we talk about margins, like I think Tencent Music should be able to do at least as well as Spotify over the long term. And actually, if you look at, like, I was reading a letter from a Spotify bull who's made a ton of money on Spotify. And in one of his letters in 2019, he wrote, and with our Spotify investment, we get I think it was at the time 9%. I forget what percentage it was. Yeah, it was a 9% position in Tencent Music, which is worth, $2 billion today. And we think it's going to be worth a lot more. And fast forward to now, and Tencent Music is down like 50%, despite the business having grown. And that's actually why I think it's so interesting. Like when it's first started trading, it was worth, like, March of 2019, it was worth like almost $20 per share. And today it's trading at 8 something. Actually, yesterday it was trading at 8. Today it's like 8.70, which I think is, I'm going to give you all the credit there in bumping up actually, no, the credit's to me, because people knew that I was going to talk about the stock. So then they got really interested in buying. Yeah.
So I want none of that credit. I never try to pump stocks. I've never tried my best. So just you take all of it. But let me, you actually touched on just about every point I want to touch on this podcast, but I want to dive deeper in them. So let me start with first question. I was aware of Tencent Music because I follow Spotify very closely. It's one of my favorite companies to think about. I always debate how big my position should be there and stuff, because I just think that the company is a killer, the CEO is a killer and everything. When I was aware of Tencent Music because of that, my first thought was, Tencent Music, Spotify of China, easy, done. That's how I mentally model. When I was prepping for this podcast, I was really surprised. They have social revenue out the wazoo, karaoke app. They've got lots of, in China, the little gifting and mini transactions are very popular, and they make tons of money on that, which was very surprising for me, much different than Spotify. So if I had just said to you, hey, Evan, Tencent, Spotify of China, how would you respond that the business is different and similar and everything?
Okay. Well, the first thing is Tencent is a different company. This is Tencent Music.
Sorry, I meant Tencent Music. Yes. That is a very fair.
But yeah, so they have two businesses. And today, 70% of the revenue comes from essentially virtual gifting in the online streaming and karaoke business. Now that business has grown a lot over the years. It's like a $3 billion revenue, $3 billion US revenue business, and it's a pretty substantial margin business. It's probably like high teens or 20% EBITDA margin. They have to pay the creators a decent cut, but at the end of the day, it's it's a pretty good business. However, it's seeing increasing competition from Douyin, which is the TikTok, ByteDance's TikTok-like app in China.
Yep.
As well as Kuaishou, I'm sure I'm pronouncing that wrong, but just like a bunch of other streaming platforms now in China that have, like, those two both have, 400, 500, 600 million MAUs in China, and are sort of, you know, putting some competitive pressure on the social entertainment business. So that business is not like Spotify at all. It's more like Twitch, or it's more like, I mean, it's more like TikTok Live. If you ever watch, I don't know if you use TikTok, but
I can get very addicted to phone apps, so I generally try not to install any of them on my phone.
But it's interesting. Like, yeah, so I watch a little bit of TikTok. I mean, I look at TikTok a lot, and I a couple like TikTok Live people I look at, and yeah, they're getting gifts all the time, like rocket ships are flying across the screen, which is like, you know, a certain amount of TikTok tokens. You know, and so so TikTok is a big competitor for them. But what's interesting about TME is actually the Spotify like business.
Mm-hmm.
I think that business alone probably supports the market, the whole enterprise value of the company, which is like, you know, on the order of $9 billion US dollars today, after, you know, where the stock is, and that's netting out the cash. And so this business today is 600 million users, which is basically flat because it's like such a high percentage of you know, just the internet market in China, right?
Yep.
It's got one major competitor that has like 150 million users. It's NetEase Cloud Music. But they're the dominant player, right, in terms of users and revenue. It's got 1 billion US of subscription revenue, which is up like 3x from a couple years ago. And only like 10 or 11% of their users pay anything, which is unlike Spotify, where you have 40% plus of users pay.
Yep.
Right. And the reason why no one paid is because historically so go back 10 years, and no one in China's a few years behind us in terms of willingness to pay for music.
Yep.
So you go back 10 years and people didn't really believe that people would pay for access to music. So you could stream anything for free, basically. And they didn't have, you could, like on Spotify, if you're on the free version, there's a lot of ads. You can't just like unlimited skip, you know?
Yep.
You can't like, and you can't, there's basically all these things where they're trying to get you to pay, right? But TME's app, QQ Music, and the other ones, they didn't have these features. So basically, the only reason why you had to pay was if you wanted to download all your music. That was like what you had to pay for. And so the number of paying users was like 3-4%. But in Q1 of 2019, they started putting some songs behind a paywall, so they were premium only. And you know, right now that's at like 25 or 30% of listening hours are of music that is like premium behind a paywall. You know, I mean, they saw the number of subscribers that Apple Music has, right? And they're like, oh, this whole thing is behind a paywall. Like, we can just do this, and people will pay for it.
I saw the thing where they put music behind a paywall to try to get people to sign up for premium. And I was just curious. I don't know. How do they decide what music to put behind paywall? Do they have data that says it? Does it have to be Tencent owned music?
That's actually a great question. I have no idea.
Okay, no worries.
Yeah, I have no idea how they decide what goes behind the paywall. But regardless, it's driven the number of paid users from 3% of the user base to over 10% of the user base
within 3 years, right? So they launched.
Yeah, like I'm looking at the numbers in Q1 2019. In Q4 2018, it was 24 million paid users, and today it's 71 million paid users. So like literally every quarter they're adding 5 million paid users like clockwork every quarter. I mean, first they have a weird calendar thing where it looks like it falls in Q4, but like on average they're just adding 5 million paid users every quarter, and the subscription revenue there has gone from like 400 million to $1 billion. So I mean, I don't see why, as they increase the triggers to as it increase like the friction and what's behind the paywall, I don't see why that doesn't go up to 30, 40, 50% over time, like to up where Spotify is. I mean, yes, it's in China versus like Western Europe mostly. So like the price per subscription is going to be lower. But right now the average price is 9 RMB, right? So it's like it's like you're talking about $1.50. It's basically on like a GDP adjusted basis. I think it's cheaper than like a Spotify subscription.
Yep.
For the average like Chinese consumer. So I don't see why the paying ratio won't be comparable to Spotify's over time. And if that happens, you're talking about a $4 or $5 billion subscription business and a $9 billion enterprise value right now. Saying nothing about the social entertainment business, which will continue to throw off cash.
Yep.
And I just don't see how that can be the right price if they end up getting there. And the frequency, like just the consistency of the growth in paying users in the online music business. And like if you just look at a chart, it is just really impressive. And I just don't see how that can be the right price if they grow to that size. And meanwhile, the social entertainment business is going to continue throwing off hundreds of millions of dollars in profits in the meantime.
Perfect.
And
go ahead.
And one other thing, so besides like this clear arc of growth with the paying ratio that's just going up and up and up every quarter, they have some interesting advantages over Spotify in terms of the structure of the Chinese market. So one interesting thing about Universal Music is the labels have a lot of power over Spotify.
Yep.
Because 70% or whatever of listening hours are of the label's content.
Yep.
And Spotify in a lot of countries, in the US and in Western Europe, they have some pretty formidable competitors with YouTube Music, Apple Music, Amazon Music. And so the labels can pretty credibly say, I mean, they're not really gonna cut off Spotify, but they can say, they can say to Spotify, you have to have our content. And we can go to Apple Music if you were to die tomorrow. Like that would suck for a bit, but if you were to die tomorrow, we can go to Apple Music. It's a legitimate, it's a threat that will probably never be realized, but it's legitimate enough that they get a pretty big chunk of Spotify's revenue, right? Whereas in China, Tencent Music has 70 or 80% of the paid users. And the label's content is only like the top 5 labels content, according to the annual report, is like 20% of listening hours in China.
So top 5 label content is so if it's only 20%, who's the rest? Because as you said, those stats are pretty much flipped elsewhere. So is the rest just unlicensed content where people are going in?
I think I'm actually not sure. I think it's a lot of smaller, like Asia focused labels. Okay. And some of it is, some of it's probably unlicensed. I mean, I know that Tencent Music has their own, they have their own kind of like will be your label thing, I believe.
Yeah, they do. Yeah, they push that real hard in their earnings calls.
Yeah, so they have that where they're and interestingly, and that actually can get us into some of the regulatory stuff. So originally, Tencent Music was the exclusive master licensor for all the labels content in China. And that relationship got dismantled by the government during the recent crackdown.
Yeah.
Which is kind of interesting. And my interpretation of what was going on there was the labels basically saying, we don't necessarily want to have to sue people in China. Let's just let Tencent worry about we'll license to Tencent. They'll pay extra because they're gonna license it back out. And if some app pops up and is using pirated content, we'll let Tencent sue them because they're going to be able to navigate the legal system better than we are. That's my interpretation of what was going on there.
So we talked about a lot of things, and I'm going to circle back to a lot of it. I just want to one thing I thought was interesting. You mentioned Tencent has their own label, and Spotify has been very careful not to encroach into labels for a lot of the reasons you mentioned, right? Spotify might have a third of the US market, but that's only a third. Tencent's got 80% of the, in the US, Spotify has a third and the labels control is 80% of music listening or something, right? In China, Tencent Music has 80% and the labels only control 20%. And when you get that big difference, Spotify can't have a label because if they did, the labels would go ballistic, and Tencent can. And I just thought that was one really interesting thing that shows how power dynamics can flip, where if you control enough of the market, you can go and just disintermediate your suppliers. Whereas if you don't control enough, that was one thing that was really interesting to me. I just wanted to harp on for 1 second, but let me back up, and I'm going to ask lots of questions on everything you just covered in there.
Sure.
The first thing I just want to start with, we've alluded to it a couple times, right? Tencent Music stock is down a lot, 50, 60%. A big part of that is from the Chinese, I'll just call it the Chinese crackdown, the CCP crackdown. You know, they've made noise about eliminating the VIE structure, which we're probably going to talk about in a bit. They pulled the Ant Financial IPO. Jack Ma, is he here? Is he not? Like all this crazy stuff is happening over China. So I just want to zoom out for a second. We can talk about all those risks, but why did you choose TME as your choice? Yeah. I mean, we talked about a little bit of the Spotify, but Alibaba, Charlie Munger backs it. That is a great business that's available at a price that makes no sense if you look at the growth rates and stuff, right? That Tencent, which controls Tencent Music, has some great game business. They're historically very good investors if you look at the game. So just why was TME your pick here?
Yeah, so for a few reasons. One is, I think it's probably easier to talk about relative to Alibaba.
Sure.
So they first of all, it's actually down significantly more. Like if you look back to early 2019, I think Alibaba was actually up like 20%, and Tencent Music is down like 40%. So if you just look sort of purely on what's down more and what could go up 3-4 times, it's a lot easier to see how TME can go up. It can be like a 4, 5, 6 bagger. Like you don't have to think, you don't have to
stretch the numbers too hard,
the numbers too much to see how they could go up that much. The other thing that I think is interesting is relative to a lot of operators in China, I actually trust Tencent as a controlling shareholder.
Interesting.
And I don't think I trust Jack Ma.
Can I pause there? You trust Tencent as a controlling shareholder, and I just want to note the difference. We're talking about TME, Tencent Music. Tencent is a different company, maybe the biggest company, one of the biggest companies in the world. They are the controlling shareholder of TME. So when you say you trust Tencent, you mean you trust them as a controlled shareholder of TME.
Right. I trust Tencent Inc. Yeah, the original parent company of Tencent Music.
Yep.
More than I trust the board of Alibaba.
And I think that's fair. If you look at Alibaba's history, I mean, they stole Ant Financial from Alibaba, and I think that's 100%
completely. And I remember looking at like Yahoo and over the years, when the vast majority of its value was in Alibaba, and I just never got comfortable with partnering with Jack Ma implicitly.
Yep.
And the other thing that I think is really interesting about having Tencent as your controlling shareholder is Tencent, the Inc. I think it's called Tencent Inc. Whatever, just like Tencent Holdco owns like 100 billion or more of minority investments in publicly traded companies across Hong Kong, the US, ADRs, VIEs. So their investment in Tencent Music right now is like a 5 billion market cap or something. So the idea that they would try something shady at Tencent Music, first of all, it's kind of out of character with like the way they've operated their business for a long period of time. Like for example, Tencent itself has paid a dividend for a really long time. They weren't one of these companies that like immediately came to the US, Tencent, to try to like arbitrage the idiocy that US investors were allowing with some of these Chinese reverse mergers. They were always listed in Hong Kong, which had sort of tighter controls historically. But they own like $100 billion worth of minority investments. Like the last thing they want to do is give anyone ideas about how to screw over like VIE minorities there's just no chance that they're going to start giving anyone ideas about how to be a poor steward of as the majority shareholder. They just have too much riding on it.
That is an interesting thought. I don't necessarily, I do agree with you on the point that Tencent historically has treated minority shareholders. I think they've treated them pretty well, to be honest with you, versus especially if you compare them to an Alibaba or just a lot of other companies with minority shareholders. I don't disagree with you that I don't think they're going to start pulling stuff on TME, which is a rounding error to them. But, I always come back to, are you familiar with Brookfield Management?
Yeah.
BAM, historically, one of my friends, I've invested in some of their minority subs. And every time I do, I just remember one of my friends when I was looking, he was like, look, BAM is a take under artist. If you go invest in something that they've got a control or semi-control stake, when things get rocky, they're going to tank the share price and then they're going to buy out the whole thing. And 3 years later, they're going to IPO it for 5 times what they paid. And you're going to look there and you're going to have said, oh, but BAM's controlling shareholder. They've got a reputation to protect. They're going to be fine. And they're going to murder you on it. And you're going to be sad. And every time he's actually proven correctly. And I don't think Tencent's like that, but I'm just saying that always comes to my head when somebody says they're not going to screw the minorities.
Yeah. I mean, it's, but I think it's a little bit, to me, like Brookfield, I think tends to be the controlling operator of most of their stuff. Like even their listed stuff, they usually have control over it. Most of Tencent's investments, they don't have control over.
They do have control over this one though, right?
No, they do have control over this one. I'm just saying, like, there are other people that have control over, 90% or whatever, 70, 80, 90% of their investment portfolio. And they're in the minority position in the vast majority of those investments. I think that is likely. I mean, granted, they could just steal, they could just try to steal Tencent Music and just like, figure, hey, we're going to do this to our minorities, but like probably no one, that doesn't mean that someone else is going to do it to us. But I just feel like that will put them in I just feel like they have a different mindset with respect to that. Like they're not structuring everything as like they want to be in control, like they're
the first time. That makes total sense, especially because a lot of times they'll do a startup business and then they'll merge it with a competitor business. And as you said, they won't take full control. So they probably don't want people starting to think, hey, if you control this thing, screw your minority shareholders up. Because as you're saying, in a lot of cases, their end game is a minority stake in a combined business.
Right. And they have $100 billion on the line with trusting those sort of relationships. And most of those involve VIEs also.
Yeah.
So I think, I think that gives me some comfort besides. And the other thing that's interesting is like Tencent itself, the company is not a controlled entity.
Yep.
So like Pony Ma owns like 8% of the shares. Naspers owns 30%, but I think there's like some type of like non-voting agreement with their shares. I forget. But regardless, it's not like a controlled entity where there's one person that can just say, hey, I'm going to do this to benefit myself. Like if Pony Ma says, hey, we're going to steal Tencent Music, like, okay, 8% of that value accrues to him. You know what I mean? Like 8% of whatever they steal accrues to him. And I just don't see the incentives being there, and then like there's some Tencent Music employees are going to own more Tencent Music stock than they own Tencent. I don't see the incentives being there for them to not like sort of treat the minorities well.
That's perfect. Let me ask a related question. This is just a general China question, right? The VIE question. So all Chinese stocks that are traded in the US domestically, as I'll call it, they're structured as a VIE because China says, hey, if you're an external investor basically you can't own stock in Chinese companies, right? So all these do these complicated VIE structures. Every Chinese listed stock in the US, I don't think with any exceptions, is a VIE structure. And that's always terrifying, right? Because as many short sellers have pointed out, one day China decides, there was some rumors over the summer that China was going to decide the VIE structure was illegal. And basically every share you owned, every China stock would go to zero. Or one day a company decides they don't want to honor the VIE and they can basically zero the shares out. So I just wanted to ask on the VIE structure, how are you looking at that risk?
Yeah, so I think with regards to the company sort of trying to use the VIE structure to like let them steal it, I think my like comments about Tencent would apply there as well, just because they're also, everything they own is the majority of what they own is VIE anyway.
That's perfect. So let's just talk the general.
Let's talk about the government. Yeah. So my thoughts about what the government is likely to do. First of all, I don't think that the incentives are really there for the government to do away with the VIE structure in a way that zeroes out existing shareholders. So I know there was talk about changes to the VIE rules and making them stricter, and not letting VIE companies IPO in the US and whatnot. I don't know that it follows that the changes would have zeroed out shareholders. I believe, my opinion is that if there is ever any changes to the VIE structure, it will be from the standpoint of, yes, let's rip up these VIE structures and let's provide a bridge to like just changing it into normal ownership. Because after all, like these rules aren't being, like these rules about foreign ownership aren't mattering anyway. Like no one cares. Like it's not negatively affecting the ability of the Chinese government to regulate these companies, right? Like they're regulating the shit out of them. And it doesn't matter that X% of Tencent Music is owned by US investors, clearly. Like that doesn't affect their ability to regulate these companies.
Yeah, I don't disagree. I always did wonder if at some point, if the trade war between US and China had gotten really bad, right? If China would have just said, hey, all VIEs are completely illegal and there's no going back on this. All VIEs are instantly canceled and international investors, screw you, I've always wondered if that was a risk.
So the other interesting thing is the VIEs have actually been accepted by the Hong Kong Stock Exchange for a long time. And if if you're an investor in mainland China, like you've been able to invest in those companies via the Shanghai Hong Kong Stock Connect for a while, for years. So there's a ton of money of mainland Chinese people invested in VIE structures via Hong Kong that I don't really think the CCP has an incentive to just like transfer to the already billionaire owners of because that's essentially what you're talking about in most of these cases. Like if the VIE contracts are ripped up, like Pony Ma and the other like 4 guys who are the VIE owners would just be splitting like some like insanely huge windfall. And like politically, I don't really know if that's actually like the best thing, and like it's interesting because it kind of flies in the face of the thesis that a lot of people have with regards to the regulations, where that they say like, well, they're just trying to tear down the rich billionaires in China and make them less powerful, like Jack Ma or whatever. But I mean, ripping up the VI structures would actually make them more wealthy.
Again, I think you're right, though. You could always have the rip up the VIE structure, and then the Chinese government comes to you and says, nice little business you've got there. Be a shame if we shut it down unless you give us all of those VIE proceeds or something. You could always run into that. But I do agree with you. I do agree.
The other thing, besides just acceptance by the Hong Kong Stock Exchange, the other thing is if you look at the regulations that the Hong Kong Stock Exchange has on VIEs, one of the things they require, they have like a long list of requirements with how the contracts have to be done. One of the things they require is a plan for when the VIE contracts are no longer needed. And the reason that they have that is because the number of industries that the Chinese government regulates with respect to foreign ownership has been shrinking over time. Mm-hmm. So like in 2017, one count of the size of the negative list was 63 different industries, and today it's 33. And actually, like if you look at the Chinese government PR releases, they actually had, for the 2020 rules, they were like, China liberalizes foreign ownership again. Like it's like they're like promoting it as like a positive thing that they're doing, and they actually removed the rules against foreign ownership of investment firms and insurance firms. So like you can just go in and I believe you can just go in and buy like an investment firm in China, and it's like completely kosher. So I think one day we're going to wake up and like the Chinese government's going to say, yeah, the VIEs are the ban on foreign ownership in this industry just no longer applies. I mean, they've already done that to tons of industries. That's
interesting because at the height of the Chinese pessimism, I did hear from a couple of friends who are, kind of China experts. They were like, hey, the market's freaking out, but they might be getting this wrong. Like, it's not that China's trying to tear up the VIEs. They actually might be trying to liberalize. Again, I don't know, but that is consistent with what my friends were saying.
And there's one other quick comment. The other interesting thing is that there are actually at least one VIE that trades on a mainland China stock exchange. So I don't know if you've heard of the company Ninebot, but they actually are the owner of the Segway brand in the US, and they have like a similar electric scooter like business that's not Segway. But they actually IPO'd, I think in late 2020 or maybe it's early 2021.
Yep.
On the Shanghai Star Exchange. And they operate VIEs. So VIEs historically have never been allowed in China, but this is the first one. And so I feel like my guess is that that was not done lightly, and that it's just another move towards sort of liberalizing that structure.
Perfect. So let me ask you a little bit about the history of this business. This business, Tencent Music, it was originally part of Tencent. I believe they merged it with a competitor, kind of spun it off, all that type of stuff.
Yeah.
You mentioned they were 4 times bigger than their competitor. I believe for a while, Alibaba had a music streaming competitor, and Alibaba actually ended up shutting that music streaming competitor down, which, kind of left the field open for Tencent Music. So right. I just wanted to go through a little bit of the history and how they came to be so much bigger and so dominant, because I do think it's a little bit instructive. And I believe they launched the paywall service about a year after Alibaba shut down their music streaming. So clearly they were looking at the competitive landscape before they put the paywall
on. Yeah, I think they launched the paywall in Q1 of 2019. But yeah, I mean, they actually got they bought, I forget the name of the other competitor that they merged, QQ Music. I think it was like CNC Music or something, or it's China.
That sounds about right.
China Music Corporation, CMC. But yeah, I mean, they through acquisitions, they came to own like all of the. It's not like they have one app that is dominant. Yep. They have like they have 3 out of the top 4 online music apps. QQ, Kugu, I think it's Kugu and Kuo Music. And actually, the regulator gave them a slap on the wrist fine for the acquisition of I think of the other competitor that was I think what the regulator said was that they should have like filed it with the competition czar or whatever, but they didn't, and they got fined like a couple $1 million or something.
Could you imagine in the US if like Spotify and Apple Music merged, didn't notify regulators, and then a couple months later the US regulators like, hey, that's going to be $2 million, Mr. Apple and Mr. Daniel Ek at Spotify. You should have let someone know.
It's I mean, obviously they don't care about a couple $1 million. It's a little bit ridiculous. They're just trying to make a point. And I'm sure Tencent probably was like, well, you guys never cared about this type of thing, so we didn't even know we were supposed to notify you. I don't know. Like, I don't know how that, I don't know what that decision was like back in the day. But yeah, it's pretty clear that they have it's not quite a monopoly. I mean, NetEase Cloud Music has been growing and like cutting into their subscribers a little bit, like the MAUs. But yeah, it's a pretty dominant market position that I don't think would be allowed in Western Europe or the US.
Yep. Let's talk. So balance sheet here, right? The company, I tweeted this out. I'll put my links to the tweets into the show notes and everything, all my tweets, which we've covered almost all the questions at this point. But one of the things that jumps out to me is the balance sheet. It's basically $3 billion of cash on their balance sheet. Plus there's a Spotify investment as well, and maybe 1 or 2 other investments buried in here, versus the total liabilities for the company. So not the debt, the total liabilities, which includes, like accounts payable, we pay our employees is less than $2.5 billion, right? So this is a massive cash balance sheet. They're starting to address that with share buybacks. I think they did $200 million in Q3, which is reasonably aggressive for a company of this size.
Yeah, I mean, they have like a $1 billion authorization, which is like a little less than 10% of the market cap or something.
Which is great, especially at these prices. It's nice to see a company down 60% actually buying back shares, but the balance sheet is still, it's not crazy out of line with Chinese companies. But when you see a company with this much cash in the balance sheet, your first thought is what the heck is going on? So how do you look at the balance sheet? How do you look at what they're going to do with shareholder returns at the price this low?
Yeah, I mean, I think they bought 13 million shares in Q1 and 25 million shares in Q2, or maybe that was Q2 and Q3. I forget. Yeah, I think that was Q2 and Q3. So they're putting some capital to work there. I mean, the problem is when you have $3 or $4 billion of cash, you kind of need to do, or you kind of have the ability to do more than $250 million of buybacks per quarter. I mean, it's just weird when the cash balance is such a large percentage of the market cap. I mean, if it was me, I would love to see them just, do a tender for, 10% of the, for $1 billion or $2 billion. Of course, companies never do that. So, I mean, I don't know why I would expect them to.
Can I just jump in here? I just want to explain for listeners. Obviously, it's weird for a company to have this much cash on the balance sheet, but I think one of the things that would stick in both Evan and I's head, because we've got familiarity with Chinese companies, is one of the old things with Chinese companies when there was a lot of reverse merger fraud going on was they'd have massive cash balances, and either the cash balance didn't exist, or the reason they had massive cash balance is they were basically raising lots of cash from investors on their fake business numbers and everything. So they were just raising cash. And then eventually they take the cash, or, they'd say, oh, we're a fraud, and people try to go recover. And it was inside of China, so external investors couldn't get access. So I just want to drive home, when I said, yes, it is inefficient for them to have this much cash, but I think lingering in the back of my mind, and probably the back of your mind too, is that risk and that thought process. Just drive that.
Yeah, certainly. I mean, you've seen a lot of the Chinese, especially the Chinese reverse mergers back in the day, like the cash just wasn't there. Right. Yep. I mean, the business wasn't there either. And so, I mean, that also happened with Wirecard, right, in Germany. But that's actually one thing I like about the way they're handling it. Like, okay, the buyback isn't quite as big as I'd like. It obviously could be bigger. But at the end of the day, I mean, most of the frauds over the years have not, where there was fake cash, like they have not instituted substantial buybacks.
Yep.
Like mostly they just would make a big stink about how the fraud allegations were unfounded, and then they would like slink off into the night,
And then 6 months later, nobody could find the CEO anywhere.
Yeah.
You said it's not a big buyback, but just to maybe push back on your point a little, I mean, as we speak, it's under $9 per share. This is an under $15 billion market cap, and I think they've bought back $350 or $400 million in shares so far this year, which Tencent's not selling, and Tencent owns about 10 or 15% of the stock or something. So 400 million on $15 billion market cap, even smaller free float. It's not the biggest buyback we've ever seen, but It's certainly not small. And by Chinese standards, it's actually pretty impressive.
Yeah. I mean, that's a good point. It's actually one of the things that makes me a little more comfortable with, how they're operating things, and like confidence that, we're going to be treated well as minority shareholders. Is like when you see, okay, stock is down 60%. What are they doing? Okay. They announced a $1 billion buyback, at pretty low prices. Then you say, okay, 2 quarters later, what have they done? Okay. They've done 300 or 400 million of it. Like, let's go. Like, it looks like this is a real thing. Like, it's not just like smoke and mirrors. Yeah, they could do more, but it definitely makes me feel good to have at least something substantial going on in that department.
Let's talk valuation, because I think we've done a couple of shorthands for valuation, right? Earlier you said, hey, this was at 20 a couple years ago, and now it's at 8. The stock's been hammered. You said, hey, I think the Spotify-like business alone could be worth the entire market cap, which would imply you're getting the karaoke business, which might not be the fastest growing business. Or sorry, I said karaoke. The social business might not be the fastest growing business, might be losing share to TikTok. But guess what? Social businesses with that many users and that much revenue spit off an insane amount of cash. There's a lot of value there. So let's just try to quantify it.
Sure.
How do you look at the valuation for Tencent Music right now?
So I think it trades at like a high teens multiple of EBITDA right now. And the question is, obviously the 2 questions are, where's EBITDA going? And where are profits going?
Always a good question.
Always a good question. Where are profits going? So okay, let's see. Bloomberg has it at 24 times PE right now.
Yep.
And I mean, I think even if the subscription business, even if the social entertainment business is flat, and it declined a little bit in the most recent quarter, even if that business is flat, I think the growth of the online music business probably goes from, I'm just looking at this, like my notes, 5.6 billion RMB to like, I have it at 40 billion RMB in 2027, which is a combination
Okay.
of paying user growth, a little bit of ARPU growth. And the question then becomes, what are they going to, like, what type of margins is that going to generate? I mean, historically, the social entertainment business did like a high teens, the overall business did a high teens EBITDA margin. And there's a little more competition these days in the social entertainment business. They increased the payouts to some of their creators on that end to try to like retain them competitively. The online music business, because it's so small, is actually not profitable right now. So that's been also a little bit of drag on margins as there like been a little bit of a mix shift. There's also a separate story about how they're investing in long form audio.
Yep.
So they have 140 million.
Long form audio is podcasting. I guess maybe audiobooks technically, but it's podcasting, just so people can understand.
Yeah, podcasting and audiobooks. And so they have 140 million users of that business with 5 million paying users already. And they bought a company for like 500 million earlier in the year. So they're investing in that. All these things have been a little bit of a drag on the margins in the short term. So the real question is, the real question in my mind is, what is the margin of the subscription business going to be in the long term?
Yep.
I think given the dominance that they have in China in terms of their control of the market, as well as the lower share that the labels have in China, I don't see how they don't do substantially higher margins than Spotify over time in that business, just because of the change in negotiating leverage with the labels. And therefore, I mean, I don't see how it's less than like a mid-teens EBITDA margin business in, once those revenues go from 1 billion US to 4 or 5 billion. That basically means if they end up doing 5 billion of revenue in the subscription business and 20% EBITDA margins, that's $1 billion of EBITDA right there, for an enterprise value of less than 10 billion today. And so when you combine that with the whatever they're doing in the social business these days, 700 or 800 million, which gets knocked down at a consolidated level because of the unprofitability of the other stuff. You're basically going to have a 1.5 to $2 billion EBITDA business in the long term, in my view, with really good economics and sort of a stranglehold on their core market and tons of good reasons why that should generate a pretty substantial multiple, I think. And so I think you end up with something that is in the range of I think 10 times, if it's 10 times EBITDA, then that's 15 to 20 billion, right, of enterprise value, which would be which would mean the stock would need to like double or triple to get there. But it could be more, right? Because if you look at where Spotify trades, it's like a 45 I think $1 billion market cap or enterprise value right now, roughly. Is that right?
Spotify, I think it's a little over 50 right now.
Is it a little over 50? Oh, okay. Oh yeah, so it's 50 billion. I mean, I feel like investors there are probably thinking of you're a Spotify investor, so tell me if I'm wrong, but like 2 to 3 billion of EBITDA with a 20 times multiple, in the longer term.
It's tough because these are online businesses. So the three most interesting tech companies to me right now, US tech companies, are Peloton, Twitter, and Spotify. And all of them are I think they've got huge potential. Let's just focus on Spotify. Sorry, I shouldn't have mentioned.
Yeah, that's fine.
For Spotify, I just look at it and I say, all right, they've got over 200 million monthly active users, right? How many businesses in the world have over 200 million monthly active users, of whom over 100 million of them, they have credit card data, people listen to them for multiple hours on end, all this type of stuff. how many businesses like that are there out there, and how many businesses are there that are less
Tencent Music is one of them.
well, yeah, so Tencent, we're gonna talk about the
yeah, no, go ahead.
But for Spotify, I just think it's look at that. Think about all of the optionality they have, which I've mentioned it 1,000 times. But as they're moving into podcasting, to get podcast advertising, to get owners' economics on the podcast, like where I was going with Peloton and Twitter is saying, I just think there's this massive right tail because they have so many users. They are by far the best product in the thing that they are playing with. Twitter is a little bit weird in that, but they've got so many users. And for Spotify, they play a little bit on hard mode because the people they compete with are Amazon Music, basically giving it away for free as part of the Amazon Prime bundle. Apple Music, Apple doesn't pay the Apple tax, whereas Spotify pays the Apple tax if you're an iPhone user. So they're really competing on hard mode and they're still winning. They're taking share, they're growing, all this sort of stuff. So if they're winning on hard mode and they've got all this optionality, you can just start dreaming up all these scenarios where Spotify, they don't compete on hard mode anymore, right? The Apple tax goes away and they compete on a level playing field, or they continue growing and all of a sudden they've got the most users and they're, I just see all of these optionalities for Spotify that it's just, and at 50 billion, again, the argument for Spotify has always been Netflix 2.0. Netflix is a $300 billion company at this point, right? If Spotify is even half that, triple from here. And I think Daniel Ek is just one of the best people out there, but probably neither here nor there for Tencent right now.
Yeah, I mean, I think a lot of those optionalities exist for Tencent Music, just constrained to the China market, which I think is very interesting.
Agree. And on Spotify, they've got some optionality from all the social stuff that Tencent Music does. I was really impressed, and they've got those optionality. But Tencent, guess what? Tencent Music owns 80% of the market. So they've probably got options that Spotify can't even dream of because they're so dominant.
Right. And of course, it's mostly restricted to China. I mean, the WeSing app is live in a few other countries. And they cite that as like, one mode of expansion for the karaoke, for the live streaming business. But it's mostly China centric, which is limiting in some ways. But I think if you get past the China regulatory issues and the VIE issues and the Tencent, majority ownership issues, which, admittedly took me 10 years to get over.
Just small issues to get over.
Then you just see a business that, I mean, yeah, it's easy to just look at it and focus on. I mean, one thing that Spotify doesn't, their investors aren't super concerned about like next year's EBITDA, obviously. And Tencent Music, because they're posting, significant EBITDA and like you can make an EBITDA multiple, their investor base is a little bit less focused on like the right tail optionality. It's
the classic thing you would hear among already public companies that had profits. They'd see, especially a couple months ago, they'd see the valuations people were going with SPAC mergers and stuff, and they'd say, wait, we're bigger, we're profitable, they're smaller and they're unprofitable, and they're going for 5 times the rate. Like, I wish we were unprofitable so people would slap a revenue multiple instead of an EBITDA multiple on us or something.
Right, exactly. Yeah, I mean, Spotify trades for 4 or 5, like almost 5 times sales, and TME trades for on an enterprise value basis like 2.5 times sales or something.
Yeah.
But they still have all of the, it's interesting, they have all the optionality that Spotify has, and they actually have optionality within the core subscription business. Like it's not even optionality, it's just like a chart that goes up and to the right, and you just have to know that it's going to continue.
Clear penetration. So we've talked about a lot of risks here, right? And most of the risks we talked about are more, because they're so dominant, the risks we've talked about are more on the corporate governance and regulatory side. Are there any risks, either operationally or corporate governance regulatory wise, that we haven't addressed that you think we should have talked about?
I don't think so. I mean, actually, what seems to me right now, given that I've kind of mentally gotten past and accepted, I guess, the VIE risk and the Chinese regulatory risk, it seems to me the biggest risk is actually competitive for them. I mean, yes, they're dominant now, but if you look at App Store rankings, like NetEase Cloud Music is actually number 1 in the like app rankings last time I checked.
Really? Okay.
And they're, I mean, It's number one in the like download, like recent downloads, I believe, in terms of music.
They've got 600 million users out of 1 billion people in China. So the issue could just be everybody's already downloaded Tencent.
Right, exactly. Yeah. So maybe that's an issue. But of course, I mean, I feel like you still see Facebook and Instagram in the top downloads, right? So who knows? But yeah, it's so competitively, I think, you know, there's a lot for like smaller competitors to shoot at. I mean, granted, it seems like NetEase Cloud Music is the only one that really has a chance to, you know, especially with Alibaba and some other ones shutting down their apps. That's the only one that has a chance to compete. But there is a big thing for them to shoot at. And separately, they have lost some users in the karaoke and live streaming business, right? Like TikTok and or Douyin and Kuaishou are like really booming, and it looks like they might be taking away some users from WeSing.
Yep.
And therefore, and that's their main source of profitability in the short term. I mean, yeah, I can make a good argument about why I think the online music business has a high profitability in the long term, but you know, for tomorrow, their profits are actually going down a little bit because of the competitive issues in the social entertainment business. I think those two things seem to me the biggest risks.
We've talked about a lot of risks here. So now we've talked operational risk, we've talked the social side risk, we've talked regulatory risk, ownership risk, all this sort of stuff. Of all the risks we've talked about with Tencent Music, which one is the one that personally kind of keeps you up the most at night?
It's what is the profitability of the online music business in the long term? Like I tell this big story, you know, I tell the story about why they should theoretically have more negotiating power over the labels than like a Spotify would have. But at the end of the day, even 30 or 40% of listening hours gives the labels a pretty good you know, negotiating leverage in terms of being able to say, like, you can't really have a music app in China without the labels content. And they could just say, hey, your NetEase is growing share every quarter. Why don't we just, you know, we can threaten to cut you out and NetEase will be happy to take this deal. And then you're done. So I do worry long-term if my story about the negotiating power really translates to double-digit EBITDA margins, which I think are likely, but you know, would be.
I will say, having done a lot of work on Spotify and the labels, I actually think they have so much share that the labels are going to be really over a barrel given the share discrepancy between them and the smaller competitors and how little the labels own. I do think that's interesting though, because I will tell you, you saw the Twitter thread. I tagged you on it. People slid into my DMs. The big risk I hear is the same with every Chinese stock, you know, corporate governance and VIE crackdown and all that sort of stuff. And it's interesting to me. You obviously have a very divergent view because your big risk is the long-term economics of this business. And the big risk that most people think about are those other things. Let me ask you a more general question real quick. You know, Tencent Music, I know you're also invested in, we mentioned Boyer, which is a French conglomerate controlled by Vincent Boyer. Some people think he's the Carl Icahn of France or Europe or whatever. And then you and I have also talked about Cogeco, which is a controlled Canadian cable company that I'm happy to talk offline, or maybe we'll do a second podcast on this or something. But that's three companies where I think most people, if they looked at them for 5 minutes, would say, oh yes, those companies are clearly undervalued, but they are controlled companies and to some extent, we have varying degrees of control of how much shareholders will really benefit versus kind of the control shareholders, or if they're really going to do the rational thing, all those types of risks. So you've got three of those companies. I just want to take a second to ask, is that the type of thing you normally look for? Or did you just find three unique companies here? How do you look at that risk?
Yeah, I think these three are, you know, out of like 10 to 12 stocks that we own are probably the only three where this issue exists. I think the rest of them are, you know, the rest of the companies we own are not like controlled entities in this way. But I think a lot of times the stories about like worries about control and how minorities are going to be treated, in certain cases, they flow more from the, like, people, I think what actually happens is people get negative on the stock after it's been underperforming for a while. And then they
use the control issue.
And they use the control thing to like kind of tell a story about why they don't want to own it.
Let me push back on that because sure. Cogeco, right? Yeah. Cogeco had a offer from Altice and Rogers, which I think the offer was too low, but they could have negotiated, right? I think Altice and Rogers were both very clear. Hey, come to the table and we'll give you a good deal more than this. And yes. Cogeco just flat out refused.
Yes.
Boyer, I think probably not there though. I do think Vincent Boyer, it hasn't exactly been super shareholder friendly over his lifetime, but I do hear you on that. But there is some evidence that these guys have not exactly done the best, most profitable things for shareholders.
Yeah, I mean, I think with the Cogeco angle is very interesting because I don't know. I just like to think. I think with any sort of like non-control situation, or where there is non-control is every stock I'm invested in. As a 50 million AUM investor, I'm not controlling 0% of the companies that I'm invested in. But while investing in companies that are controlled by other people, I of course generally see it as a slight negative because the likelihood of there being a major buyout is the risk of things that are adverse to your interests is always present. However, I just like to think of the incentives of the people that are operating it. And I think, for example, in the Cogeco scenario, the guy who is the current chairman, Louis Audet, is I believe the son or the grandson of the founder.
Isn't it Louis Audet like the third or fourth? Am I
maybe he's the fourth, not the third. I'm not sure. Yeah. Oh, you mean his name or the?
I think his name is Louis Audet the fourth or third, and I think he's the third or fourth CEO. I can't remember.
Yeah, I think it's something like that. And they see it as representing their the thing that their family created, and so there's some pride in keeping it in the family and all that. But I think a lot of times those sort of issues can get overplayed in terms of the impact on the valuation. Like, a perfect example is we were invested in Fox back in the day, and forever you heard that Murdoch will never sell, and he wants to keep it all in the family, and his sons are coming up in the business, and he's gotten offers before, and blah blah blah. And then he woke up one morning and was like, you know what, I'm getting pretty old. Let's sell a huge chunk of this while we can get a good valuation. And then, my one son can go to that company. My other son can go off into the woods or whatever. And he ended up selling. And it's like, despite the fact that, go ahead.
No, we could have the Fox discussion another day, because I don't disagree with you there. Though, if you do think back to the Fox case, they would not talk to Comcast, right? And then Comcast came in and threw in a bid that was like 50% higher than what Disney's original bid was. And then Disney and them got in a mini bidding war, right? So I don't disagree with you, though. It took him much longer, and I think he could have done a lot more shareholder-friendly things in the meantime before he sold. And even when he sold, it was really inefficient, right? Like, if you sell and then an obvious strategic buyer comes and offers you a 50% premium a couple months later, like, clearly you didn't do a good enough job of shopping. And I think he wanted Disney stock and a semi-control. Neither here nor there, we could have that conversation, but it's just interesting you chose that case because I'm familiar with it. And Dow Jones right now, or News Corp right now, he controls that, and people are still having the same, hey, is this guy going to? It's just a really interesting case that shows every story. There's like 4 different sides to it.
Right. And I mean, honestly, I'd prefer to own, I like owning things that are undervalued now. And yes, it hasn't been, I mean, obviously any stock that you can buy right now has not been sold yet. It has not been sold to a competitor yet. So it's kind of, just part of the equation. But I like owning things that are obviously cheap and where there's obvious bidders for it in the long term. Okay, yes, the CEO currently is no, we're not going to sell. Please don't give us better offers. But in the long term, if the guy's in his 60s or 70s, I forget how old Louis is. I think he's late 60s. in the long term, I don't think any of his sons are like running the business. Like at Bolloré, this is not true at Bolloré, but it is true at Cogeco. His sons are not running the business. Rogers continues to own 30+% of the shares.
And Rogers is another one with a very interesting.
Right, and then Rogers has a whole other story. But like Rogers definitely wants to buy Cogeco one day, right? Like they've been at this for fucking decades.
They do, but I think because Rogers is buying Shaw, and we're probably getting way off track here, but I think Rogers buying Shaw is them throwing the towel in on Cogeco, and I think what Rogers does with the Cogeco stake will be interesting because I wouldn't be surprised to see them sell it or dispose of it. Could Cogeco try to buy the whole block, which would be a bonanza for shareholders? I know some people are worried they're just going to sell it on the open market and hit the price for 6 months or something, which is probably opportunity, but that's an interesting one as well.
The thing is though, like this combined Rogers Shaw entity, I don't think the math works on it, that being like them throwing in the towel, just because like the combined entity will have what's like so the EBITDA of Rogers is 5 billion. And the EBITDA of Shaw is like 2 billion. So it's like 7, but like the amount of free cash flow that company's going to have, it won't really take them, like in 5 years, they can easily buy Cogeco.
I don't think it's a financial capacity situation. I think it's a regulatory situation where they're struggling. They're going to struggle to get the Shaw deal over the finish line. And I think it's kind of like Comcast and Charter. I think Comcast and Charter should be allowed to merge. And frankly, I think they should merge, but talk to either of them and they'll be like, yeah, we don't compete with each other, right? Like our cable systems are in New York, their cable systems are in Philadelphia. But guess what? Regulators aren't going to let us merge because we're just going to be too big. And I think they'll run into that. Last two more quick questions. Then I'm going to let you go. Things that are trading undervalued. It strikes me, it's always trading undervalued. Some part of Liberty Media. Are you in any Liberty Media stocks right now?
I am not. I've always watched the, that business unfold over the years. Why? What's sort of most catching?
I'm going to tell Faux Greg Maffei, and Faux Greg Maffei is going to be mad at you, and you're going to have to deal with the wrath of that guy. And I wouldn't want to deal with his wrath. Yeah,
it's hilarious because if you looked at my Bloomberg right now, I actually use one of his. I use his alter ego's FA like custom sheet on my Bloomberg. It's actually stuck. I won't reveal the name of the alter ego, but it's every day on my Bloomberg I see his alter ego's name.
We'll have to talk about that offline. And then hey, just podcast listeners, we're doing a Liberty Media Day is a week from today in New York. If you're up here, I don't know where are you from? Where are you based?
I'm in Philly.
Okay, you're in Philly. Oh, when I said Philly, you've got the Comcast. If you want to come, me and a bunch of Liberty investors are meeting up after, so that would be a lot of fun, and
interesting.
That would be great. But last question, which wraps up nicely: where can people find you if they're looking for a little bit more?
My Twitter is @EvanTindell, and otherwise, Bireme Capital. We write stuff on the blog there, BiremeCapital.com.
Want to spell it out for Bireme, out for people just in case they were wondering?
Sure, yeah. It's BIREME, and I assume that your listeners are smart enough to spell capital. So
I'm hoping so. And I'll have a link to his Twitter account and to the website in the show notes. So people who want to follow up can follow it there. Evan, it was great having you on. We started the Cogeco talk. Maybe we'll just have to do Cogeco or another one, but looking forward to next time. And thanks for coming on.
Yep. Thanks, Andrew.